Okay, guys, it is the infamous waterfall model with IRR hurdles. It's probably one of the most complex models. It's just really, it's a lot of net present value stuff, a lot of complex logic, and it's really difficult to make sense of. So what I've done, I've taken a waterfall build and I've built an entire real estate assumption base around it in order to come up with a cash flow per month, which can then flow into the waterfall and then get an output like this. So, I mean, if we want to start at the beginning, what a waterfall does is you've got an agreement between usually two different parties. It could be more, but basically it says you're going to split the cash flows differently over time based on what the internal rate of return is of the project over time, which the internal rate of return obviously changes every new month where you have more cash flow. Um, so what else? Waterfall uses each IR hurdle. Right. So this model is going to give cash flows um, on three different levels, and then if the third level is reached, it splits everything 50-50. Now the reason why these are used in real estate deals, joint ventures, is because normally you've got one party, which is the sponsor, that says, well, I'm going to do all this work, I'm going to develop it, put in all the time and effort, and to do that, I need some kind of compensation besides the par passu rate, which is just the amount they invested. So let's say that the sponsor puts in, let's say it's just a for simple case, $100,000 deal. Investor puts in 10,000, sponsor puts in 90,000. Now the investor doesn't do any work; they just give you the money, but they give you more money, so they should deserve somewhat of a higher return. However, the sponsor is saying, well, if I deliver an internal rate of return on your investor money, that's a given rate, then I should get a boost to my return and make you get a little bit less. And then if I get past the third hurdle, the IRR hurdle, any cash flows that are remaining get split 50-50. So that's the deal. That's what's going on, and it's so hard to do this right. Um, but let's look at the easy part first. So the easy part is the pro forma, and here we just have month zero, and we've got cash flows. The only cash investments would be construction or land or other startup costs. This could be if you're just going to buy the building. Whatever the case, these rows will contain all your cash outflows for getting this operation going, purchasing, construction, whatever. Um, so that other than that, you've simply got your net income, your rental income, vacancy income, expenses, your net operating income, debt service, and then you've got cash flow before taxes, exit value of building, debt payback, cash to be split. Now, if you want to get more in depth with this, go into taxes, depreciation, and anything else, the best way to do that without breaking this template is you can add other rows and just have those rows flow into this cash to be split row. Because this is what is going to be pulled into the waterfall. So whatever's in this row over the amount of months, it goes up to 20 years worth of months, is going to pull and then split. So that's the pro forma, and then I've done an annual roll up just so you can kind of visualize it a little bit easier over 20 years. Um, so that's the pro forma. So that we use this simply to build some cash flows, and you could honestly, you could just take this waterfall and enter cash flows in here starting in month zero at whatever you think they're going to be, and then it'll split it. But I decided to build actual pro formas around this and then have that flow into here. And then the assumptions, you've got some controls here. You can do the year the project starts. You could pick the month the rent starts. Like if I put in, say, May here, you can see rent's not going to start until May. Um, but the property taxes and insurance do start right away as soon as, basically, this is assuming it's being constructed as we speak, starting in January or whatever, um, the first month is that the project is starting. So other than that, nothing else will start. All these other operational expenses won't start until the rent actually begins. Um, so that's that. You could do expected rental income per month. You could put a number in here, and then you could do what you expect to increase your rent by year in here. That will give you a table of annual rental income, and then all the pro forma does here is just look up that table for what year it is. You can see it increases by year 2. We're at 51,000 a month instead of 50. So it just propagates that and allows for some adjustments there. Vacancy you could just change. Month of exit cap rate. So this is if you're going to exit. Let's say you're going to exit in 2028 at 11% exit cap. All that's going to do is look at the monthly. It'll go to 2028. Oh, right here, 2028. And it's going to say, well, you still got a debt balance here of 300,000, but you're going to sell the building at an exit value. This is just taking the net operating income divided by the exit cap. And then you see we got to pay back the debt, so the net cash flow here is going to be 3 million, which is just taking net operating income less any debt service, less the debt payback, plus the cash flow from the exit. And then again, you can add rows in here if you want more granularity to different line items, and just make sure the cash that's going to be finalized and split is in row 49. So that's the exit, and that's how that works, and all the cash flows stop at that exit. So that's pretty nice. It's dynamic. You see here, if you look at the annual, you see there it stops in 2028. So that's pretty nice functionality. We can go up to 20 years or 240 months. What else we got on the controls? Oh, then just financing. So you could pick the month you plan on having financing and the amount and all that. And that all flows dynamically. So that's the easier thinking. The easier part of this is just, what are your cash flows going to be? So I've built some assumptions here to do fairly granular monthly pro forma. Here's a debt schedule that flows from that control. Whatever you enter there goes into here, and then this is what flows to the model. Now here's the hard part, the hurdles. So we've got some descriptions here if you want help, but these should be white. So this is going to define. This is saying right off the bat, the investor and developer are going to get a split that's equal to their investment, and that is going to be determined right here. You actually, on the return summary, you're going to put in the percentage of total capital that the investor and developer contribute, and the total cash required is just going to take all the negative values in row 49. Reason being is it's assumed any negative net income is going to be startup costs, because you're only going to be negative before you start rental income. So assuming the rental income is not starting on the first month of the year, then basically it's just going to be property and insurance accruals and construction, land, and all those costs. So that's what it's taking, whatever you put into these rows and this, which you're going to adjust here too if you don't want this to come through. You can just put 0. And you can see the cash flow would be then negative 1.277 million. So it's saying, well, the total amount of money you're going to need is that. And so how are you going to split that up? Well, I'm going to go get some investors, and they're going to give me 1.1, and I'm going to put in 100,000 myself, 127. So that's where this 90-10 is coming from, and that would change, obviously, if we just change these, say you did 20-80. So let's 20-80. This is saying before any hurdles are reached, we're going to split it 80-20. Now, what happens when we get to the first hurdle of 15%? Well, from 11 to 15%, you're going to split this 70-30. So any internal rate of return let me see if I'm thinking about this right. 15. Yeah, because anything over 20 is going to be 50-50. 18 to 20 is going to be 55-45. 15 to 18 is going to be 60-40. So 11 to 15%, and that's why this is like the base hurdle. So anything over this base hurdle, you're going to start splitting cash flows. So if you look at our waterfall here, it's going to say, well, here's the cash flows going out right here. And how are we going to split that up? Well, obviously, it's going to be the exact percentage that you put in for on the negatives, because that's before any returns actually happen. But what's interesting, let's scroll down here and see if we hit it. Okay, so it's saying in month 95. So at month 95, it's saying the net present value of these cash flows is greater than 0 for the rate of return of 11%, which is your base hurdle. And on a monthly, it's just going to be F4. So you can see why these are all, this is referencing, has one of the references here is F4 right there. See, it's taking the net present value of the hurdle as the rate, and then the cash flows are going to be obviously the cash flows after month 0, so C10 to C104, which is going to keep going down as you go down the row, so C105, 6. So if that's less than 0, that would mean you have not reached the hurdle. So if it's less than 0, then you're just going to take whatever cash is available at the base, which this cash flow available to investor at the base is just going to be the percentage defined in the hurdle rate, or actually in the returns rate, because it's the base. Now, what happens? Why does that go to 0? Well, as soon as, let's say, the net present value of these is not less than 0, that means we're putting 0 there because we now want to put the rest of the cash flows into a different split. So you can see some of this still hits in 95, but not all of it. And then here we're now splitting no money at the base. So any more funds that come in, so now we've got more funds. So say this 25,000 that comes in month 96, we're going to split at hurdle 1. And I'll show the math here. So hurdle 1 is now splitting this. Is that it? 17 divided by the cash flow for that period, which is 25,000. Now splitting at 70%. And then you can see if we go above that, let's say anywhere up here, divided by this, 80%. So you can see the split of the remaining cash balance, which this is the balance remaining. And the only reason why you need this is because you might not have all the cash. Some of the cash flow here is basically saying up until this 8,957, you have not reached your internal rate of return. Then the cash flow after that, so 13,800, and then anything going down further than that in time is going to result in an internal rate of return that's at least 11%, but not greater than 15%. So then that splits, and actually now in this scenario we don't even break through hurdle 1. Oh wait, yeah we do for a couple periods here. So now in month 121, based on these cash flows happening, we have to split the rest of it up into the next hurdle. So this 27,000 is saying, okay, take the total cash distributed minus the cash flow that's getting distributed to the investor in hurdle 1. And then you have the cash left for hurdle 2. Now hurdle 3, we're actually not getting to hurdle 3 until the actual exit, and when that final bit of cash flow comes in, you can see this is now taking the cash flow here minus the cash flow to investor in hurdle 2 minus the cash flow to the developer. And it's saying, well, there's still 2,300,000 that we still have to split after we've gone through the first couple hurdles. So let's split that up, and then that's going to be, you can see how this is split up. Let's see. So cash available to investor, this divided by here should be 76. Hold on, what is that number? That's not the split. Cash flow to investor. $43, that's not it. I'm trying to see what, oh, right, we have a final split. So the final split here is going to equal C3.1. So this is of the 3.1 million. So it's saying the cash flow to investors is going to be 1.7 divided by this, and it's not half yet, so 54%. And then to the developer is going to be 46, and that should follow the hurdle. Well, that's going to be through all these hurdles. So that final split is going to be the cash flow. So it's going to say, well, some of that cash was oh, wait a second. 54 and 46. So where's this number pulling? Let's see. It's taking the cash flow to the investor at the third hurdle plus the remaining balance times investor share final, which is going to be let's see, there's name ranges here. Investor share final, let's see, where is it? Oh, hurdles D15. So that's doing 50%. So it's saying at that, it's saying the 13, basically it's saying you've got 1,015,000 that's already been split, and then you've got 1398 remaining, and we're going to split the rest of that by 50%. Let's just see, does that make sense? 5. Yes, because it's taking the cash flow to developer at hurdle 3 too. So the reason why it's not an exact 50-50 split yet is because we haven't reached past, and if you look down here, 20%, we haven't reached, well no, we have reached 20%, so some of that is going to be 50-50, but not all of it. And you see there's like a 1% less here and 1% more. Where are we at? So basically from 20 to 22.1%, that 2.1% of a hurdle worth of cash flow is going to be split in half. And it really, the reason why it's confusing here is because it doesn't even happen until, you see these are the same, the 16, 6, 8, and 11, 2 is the same as hurdle 3 because this is still not. But when we get to that final cash distribution, you've got basically half of this, some of it coming in at 50% and some of it coming in at 70. And that's why you're a little bit lower than 55 here and a little bit higher than 45 for the developer. Even though the developer should be 45 and that's 55 at hurdle 3, on the final it's 50-50. Which now if we put this hurdle up to 25%, you can see it won't change. It'll be the same. And there, yeah, see that's the same. 1784, 1784, 1386. But if we switch that final hurdle down a bit to, let's say, 21%, so now even less is coming in, you've still got to split up 834,000 by 2. So what that's doing is you do 834 equals this times 0. It's doing that 417 plus what was already allocated, so that should be plus here. And there you go, the 1742,878. That's that figure, and then they're splitting that 834 in half. Or the developer side is going to do plus what they've gotten by hurdle 3. 421,770. Oh, whoops. This plus that. So 1428,214. That's that same number. So that's what it's doing. It's basically carrying the balance. So it's saying, well, you're actually not going to break the hurdle rate until your final exit value. And when you do, only $834,000 is going to have to be split, because up to that point, the cash flows don't reach that final hurdle of 2021. Now, if we said this final hurdle was, let's say, 18, and then we move this down to 16, and then maybe this down to 14, now there's going to be a lot more split at 50%. Yeah, 2.2 million gets split at 50%. And so this is granular enough to deal with a situation where only the last month is split in a different hurdle and the rest is not. If, say, we reach the hurdle rate up here, let's just try to do this. So let's put this hurdle rate up at, say, 14. Do 13, 12. Now look at, we're splitting 50-50 for the last, 13 months is split 50-50, which is good for the sponsor because obviously they started with a lot. They're going to be starting with a lot less capital, so they want to get the higher, as high of an internal rate of return as possible as soon as possible. And because they're going to get more percentage share as you go up in time based on the promotes. So you can see here, easy, simple way to look at it is base hurdle. It's going to be pari passu up to month 95. Any cash flow after month 95 is going to be split based on hurdle 1. Up to month 100. Then month 101, any cash flow in month 101 down to 106 is going to be split based on this hurdle. And hurdle 3, anything from month 106 to 114 is going to be split by that percentage. And you can see each time the investor's getting less of the initial cash flow here. So hurdle 3, they're getting 14,000. Available. Here they would get 15,000 available, 18,000, and 20,000. So that's how it kind of changes over time if the sponsor has gotten a given IRR for the investor. Okay, so that's the explanations I got for you. It's super complex, but that's what I've done here. And I've added, you can see now, based on what I just told you, this chart shows the changes based on the hurdles. Let's make this a little bit bigger here. So it's saying, if the entire deal happened at base, the sponsor is going to get 930,000. Then the investor is going to get 3.7 back, and that's net back. So you can see that's after. That's not including your initial investment. That's the cash after. Um, you can see if you only got the hurdle 1, this is the split. Hurdle 2, this is the split, and this is hurdle 2 saying, well, you're going to actually have some at the base, some here, and some here, but it results in this final cash distribution. Hurdle 3, you can see a little bit more, and then the final is even more. 2.8 and 2.59. You can see that 2.59 matches this. And that's pulling right from the waterfall here. So all the numbers check out. And the reason why, we also got an internal rate of return up here, 31% for the sponsor, 21% for the investor. And that extra IRR is because the sponsor is actually doing more work than their money is. So that's the extra compensation they're getting, because it's not just their money that's doing the work, they're actually doing work too. So I put also like some metrics here. Years held 10, that's going to be dynamic based on what you do in the control tab. You've got return per year, which is just taking the total cash returned and doing that divided by the years held. So it's saying, look, if I put 255,000 out, I'm going to get 223,000 back in every year if you annualize the entire money you're going to get over the life and put it into a yearly basis. Obviously, you're going to get more in different years based on the rent changes and the exit value. But it's just a hard dollar amount that's interesting to see. And you can see the investor puts up $1 million and they're only getting 300,000. Not that much more than the sponsor, which is putting in about 20% of what they're putting in. But again, the sponsor is doing all the work, so that's why there's that there. But yeah, this is a nice grid to show. Look, the split's 2080 at the start. After hurdle 1 is 2871. Hurdle 2, 3663. And the reason why this is not going to match the hurdle rates here, like 60-40, 55-45, is because some of the cash flow is being split at base. Some of it's being split at this hurdle. Some of it's being split at this hurdle, and then the final. So it's actually not going to be a smooth split based on the hurdles, since you're getting some split at each hurdle. But over time, you can see as the hurdles go up, the sponsor is getting a greater percentage split, and the investor getting less than what they started out at. But they're saying, well, I'm willing to do that if we meet a certain IRR over time. Now what you can do is take this waterfall, and here's your cash flows if you want to do actuals, and just put what actually went out and what actually came in, and it's going to do your final is going to update based on that. So this final, you can see the final is actually the same for the first, before anything gets split. This is going to match exactly, these are all the same. 16.6 and 14.6. Or sorry, 14.6 and 3.6. 3.6, 14.6, 3.6, 14.6. Because nothing has changed. So the final split, this is the most important row. This final split is going to be what you're looking at for distributions over time, because this encompasses everything that's happened through the first 3 hurdles, and it goes all the way to the end of whenever the cash stops. So this is going to be the same as hurdle 1 here. It's going to be hurdle 2 whenever hurdle 2 starts, and then hurdle 3, it'll match hurdle 3 and 4, and it changes as the values. Let's try to show you that. Let me find a split. Okay, so here's the first one. So you can see it's taking hurdle 1 up until this point. So that would be 18.2 and 7.8. And then it's going to switch to 15.6 and 10.4. So there you go. Final split 18 and 7, and then look at, you got the 15.6, 10.4. So that's pulling. This is going to pull the correct amounts based on where you're at in the hurdle cycles over time. And at the bottom here is just showing you the IRR. So this is going to match the hurdle rate. You see 13, 14 because it's this is how we're netting out any cash over the hurdle rate. Because there you can see the actual internal rate of return, the annualized, is based on those cash flows. Those cash flows have to stop as soon as the internal rate of return hits that hurdle, and then any cash flow in excess of that 13% is then going to the next one and the next one. So that's how it's working. See 14, and then the final split will always be not a clear number because it's taking the aggregate of all of these. So whatever's at 14% or that hurdle rate, this hurdle rate, that hurdle rate, and it's doing combining everything. And you see here's the project analyzed IRR is 24. That's just doing the before anything gets split, it's 24%. Okay, well I think I've tried to explain this in a way where if you had no idea how to do waterfalls, hopefully you now understand what's going on. And then this template is available. I'm only charging $45 one-time fee, and that covers basically my time it took to go ahead and build like this annual pro forma, the debt, build this return summary, and make all this stuff flow in with the waterfall. Let's see, did I forget anything else? I don't think so. And this is probably the best chart to show investors because they can clearly see what their cash flow looks like at each hurdle level. And then they can see what their final split's going to be. Now, if we got no hurdles, you'll see the final split will actually match the first one. So let's say the base hurdle is 35. So we're not going to get to any hurdles. You can see the final will match. Let's say we only got to, let's say we got 11, 15, and then we only got to hurdle 1. You can see now hurdle 1, and that's what the final is going to be. So the final is going to be, the only way the final is going to change is if you've gotten your any cash flow that resulted in an internal rate of return that's higher than your final hurdle. Otherwise, it's going to match whatever the last one of these was. Which here you can see we only got the hurdle 1, so that's what the final ended up being. So that's a good thing to show investors. They can really see how things change, what the final cash split's going to be, assuming these assumptions, what the internal rate of return is, the return per year, years held, all that, and all that changes with these assumptions. All right, that's all I got for you. This is the waterfall model with internal rate of return hurdles, and it's based on a real estate pro forma. Oh, and also you can use this model with any of the financial models at smarthelping.com. All you have to do is get the cash flow, that cash flow line into here, because all my other models, obviously they have this, they will get to a cash flow for you, and then you just plug that into here and you'll get a waterfall breakdown if you have that scenario where you're getting investors on, but you want a promoted rate if you get the investor a given rate of return on the business they invested in. But normally this is used, the most common thing this is used for is a sponsor and investor of a real estate deal. And you could have multiple investors. This is just assuming all the investor pool is going to be at this hurdle rate, and then you could just simply split. Say you had 5 investors that are all going to agree to this hurdle term. Then you've got 5 investors. You just divide the net cash in and the cash out by 5. Just divide everything by how many there are, and that would give you your amount for each individual investor, and then the sponsor is going to have their own unit. All right, this is smarthelping.com. Have a great weekend.